Okay, so right now, the world of artificial intelligence is just electric. We are seeing these mind-boggling valuations, companies spending billions and billions of dollars to build out the future. But all this frenzy has kicked off a massive debate. Are we watching a real honest-to-goodness investment boom built on solid ground? Or are we just pumping air into a huge, unstable bubble that's going to pop? Let's break it all down.
So that's the big question, right? Are we in an AI bubble? You hear that word bubble being thrown around everywhere, and you know the stakes could not be higher. We're going to dig into both sides of this thing using insights straight from top investors and analysts who are in the thick of it.
All right, first up, you've got the optimists. Byron Dieter from Bessemer Venture Partners, he's basically saying, look, what's happening now is fundamentally different from past bubbles. He thinks this massive spending is totally justified by real fundamentals and just incredible revenue potential. It's not just hype, it's a real scale and monetization cycle.
But of course, then you've got the other side, the cautious take. Eric Sheridan over at Goldman Sachs, he's pointing to some worrying echoes of the past. He's nervous about this idea of circularity in the ecosystem, where it seems like money is just flowing in a big loop between the same few giant companies. And that raises a huge red flag. Is this growth actually real, or is the whole system just propping itself up?
Okay, let's dive into that first argument, the not a bubble camp. And the core idea here is that the companies leading this AI charge, the Magnificent Seven, are absolutely nothing like those speculative startups from the dot-com days. These are established, wildly profitable giants. And this is where it gets really interesting, because the numbers, they tell a pretty clear story. Just look at the difference here. The Magnificent Seven have a net income margin of 29%. The tech leaders back in 2000, only 16%. And check out the balance sheets. Today's giants have almost no net debt compared to their equity. Back then, companies were just piling on the leverage. This isn't just apples and oranges, it's more like a fortress compared to a house of cards.
And really, that's the whole ballgame right there. Real cash flow versus speculative hope. The dot-com bubble was fueled by people betting on future profits that, for a lot of companies, just never showed up. Today's rally? It's being driven by companies that are generating insane amounts of free cash flow. I mean, they're so flush with cash, they're doing stock buybacks and paying dividends. That was basically science fiction for most tech companies back in '99.
This chart just lays it all out perfectly. And yeah, today's valuations are high. A forward PE ratio around 27 is definitely nothing to sneeze at. But look at the peak of the bubble back in 2000. The top tech companies were trading at an astronomical 52 times their future earnings. We are just not in the same stratosphere of crazy speculation. Yeah, and this quote from Peter Oppenheimer really just nails it. The incredible run-up in stock prices we've seen has been matched by an equally extraordinary rise in their actual earnings. So far, the growth has been real, it's been fundamental, not just a fantasy about what might happen way down the road. Okay, but that is only one side of the coin. On the other side of this argument, there are some legitimate signs of froth that have analysts pretty worried. And this whole argument really centers on two things: the absolutely massive scale of the spending and this weird circular way money seems to be moving through the system. So this is that circularity concept that has people so nervous. It kind of works like this. NVIDIA, the big chip maker, invests its cash into these hot AI model companies. Then, those model companies turn around and use that same money to buy cloud computing power from the big hyperscalers, like Microsoft or Oracle. And who do you think the hyperscalers buy their chips from to provide all that power? You guessed it, NVIDIA. It creates this closed loop, and you see the problem, right? The big question is, how much of this is actual real demand from outside this little club, and how much is just the ecosystem funding itself? All right, to really get a sense of the sheer scale we're talking about, let's walk through this incredible calculation from David Kahn at Sequoia Capital. It all starts with the foundation of the entire AI stack, NVIDIA. Their projected run rate revenue for Q4 is a mind-blowing $150 billion. Okay, now stick with me here. Kahn says you gotta double that number. Why? Because those chips, as expensive as they are only about half the story. They make up about 50% of the cost of a new data center. The other half is all the other stuff: power, cooling, real estate. So that $150 billion in chip money implies $300 billion in total annual spending on data centers. And this is where it gets really wild. To justify a $300 billion investment, the industry has to generate enough revenue to actually pay for it. Kahn argues you gotta double it again. And that gives you AI's $600 billion question. Can this industry generate $600 billion in new annual revenue to make all this spending sustainable? Because right now, it is not even close. Which, brings us to a crucial reality check on the tech itself. While everyone's talking about artificial general intelligence, NYU's Gary Marcus brings us back to earth and reminds us that today's tech, while super impressive, isn't there yet. So, can autocomplete on steroids, as he calls it, really generate the trillions in value needed to pay for all this? That is a very open question. So let's zoom out a bit. Forget the market debate for a second and think about the real world. Because whether it's a bubble or not, this massive investment in AI is absolutely going to reshape our economy. And that means incredible opportunities, but also some pretty significant risks. First, the good news, and it is huge. Goldman Sachs research estimates that once it's fully adopted, AI could boost annual productivity growth by 1.5 percentage points. I mean, that is a transformational number that would create trillions of dollars in economic value and could fundamentally change how fast our economy grows. But you knew this was coming, right? Whenever you talk about a massive productivity boom, the very next question is always about jobs. If AI can do all these tasks, what happens to the people who are doing them? Well, the analysis here points to something a little more complicated than just, the robots are taking all the jobs. The estimate is that maybe 6 to 7% of jobs could be displaced. But, and this is the important part, it would happen over a decade. That slow, gradual pace, if the economy is growing, should allow most of those workers to find new roles. The big if, though, is that an economic downturn could speed up those job cuts in a big way. Okay, so we've heard the bull case, we've heard the bear case, we've looked at the economy. What does this all actually mean for you, for investors? How do you even begin to navigate a market that's this complex and this polarized? Probably one of the most important things to remember is that the risk of a total system meltdown is way lower this time around. The dot-com boom was financed by a flood of speculative IPOs and just a mountain of debt. Today's AI build-out, it's being paid for mostly by the massive free cash flows of the world's most profitable companies. Their balance sheets are rock solid, which really limits the chance of a wider economic crisis if this whole AI thing stumbles. So, boiling it all down, what are the key takeaways? First, diversify. The fact that this is so concentrated in just a few US tech stocks is a risk. Second, you gotta watch the fundamentals like a hawk. This whole rally depends on earnings continuing to grow. Third, think about the knock-on effects. This AI boom needs a ton of physical infrastructure, which creates opportunities in places like energy. And finally, for any new AI company, demand a real sustainable business model, not just a cool story. Look, at the end of the day, bubble or no bubble, one thing is absolutely certain. AI is a transformative technology that is going to redefine entire industries for decades. So the real question for all of us isn't whether it's happening, but how we prepare for the monumental shift that's already here.